This is the Daily Market Rundown live from the Tradelo trading floor. It's May the 19th. Some highlights from today's show. Moody's downgrade puts profit taking in view. The US beautiful bill passes the House, and SPY correlation with yields is set to correct. Good day, traders, and welcome to another week of futures trading. This is Brannigan live with the Daily Market Rundown. Let's get stuck straight into it. So there's a couple of things going on overnight, of course. We're going to start off with our first topic, which is very much not necessarily new news, but to introduce the topic, I was asked a question this morning on Twitter about why I thought this was significant for the markets. The reality is it's significant more from a technical perspective more than a fundamental perspective. What do I mean by that? Well, when Moodys downgrades ultimately the US, they're bringing it in line with where Fitch and S&P have in terms of credit rating. So at that point, it means there's no actual physical selling that's going to come from big institutional players. Okay, so very much from a fundamental standpoint, this is less significant. Okay, it's just one of those sort of things that brought them in line. Now, keep in mind, of course, Fitch did do the downgrade of the US back in 2023. So it's not new fundamental. It doesn't have any fundamental significance for the market. What it does, however, have is perhaps more practical implications to the markets in the sense of the technicals right now are pointing to a correction. Okay, so what do I mean by that? Well, if you, of course, go back to April when we had the 90-day extension, markets, by and large, I mean, the NASDAQ has re-entered a bull market. It's had a 20% rally in a straight line with absolutely no pullback. Okay, it's gone from extreme oversold levels to overbought levels in a very, very short space of time. Okay, it's the same for the S&P and it's the same for a number of markets. In other words, this move has just simply come at a time where the technicals are pointing towards the market needing to take a breather. Okay, also factor in Friday was OPEX, which means we have this little bit of a period of window of weakness where there's a little bit less hedging support for the markets at these elevated levels. Okay, now, of course, there is a fundamental angle to this as well, which we'll get into, and that's the key to understand. But right now, what you're seeing on screen is not fundamentally driven, okay? And we could say that because if it was fundamentally driven, if it was concerning, the DAX would be down a lot more than 0.25 on the day. Gold would be up a lot higher than what it is, and German bunds would definitely not be down on the day. Okay, so fundamentally, this is nothing. It's a nothing burger. It's very much technically driven, and it's important you understand that because it means the degree ultimately of the sell-off today, tomorrow, over the course of this week is going to be somewhat limited, but there is a caveat to that, and we'll talk about that in a minute. Okay, so with all that in mind, let's just talk a little bit about ultimately what's going on. The key takeaway is more on the next screen. You can go read that and take a picture of it. The key takeaway is ultimately how the markets are responding to this. Okay, and I'm going to do some annotations here, but we can see very much it's a dollar move. Okay, and if you cast your minds back, of course, to April, we saw that the key plays when we had the risk off was very much money flowing into Europe out of the US. So we had dollar weakness across the board. We also, of course, had gold outperforming with German bunds outperforming. Okay, we've seen that exact play today where we can see those US 10 years down 0.87%, whereas German bunds only down 0.5%. Okay, we can see that with the gilts as well, only down 0.5%, and very much a steeper curve. Okay, so this is almost a replication of what we had back in April. We also look across the dollar space. Interestingly, if you go back to April when we had that extreme volatility, it was the Swiss and the yen that led ultimately the move. However, notice today, this is very intriguing, is that the euro and the pound are the two outperformers. Okay, that in its own is quite an important clue that perhaps this is less of a risk-off move and perhaps more just reigniting some of those flow-type moves where we are seeing this rebalancing play where a lot of portfolio managers are now wanting less exposure perhaps to the US and a little bit more exposure to some alternatives like Europe. Okay, and I think that's kind of what we're seeing today. It's less of a risk-off and perhaps more just a shifting of flows. Okay. We can, of course, see the likes of Bitcoin a little bit down on the day, but it's very, very obvious what's going on here. It does seem to be that flow-driven thing. Now, there's a few things to understand. Of course, we did have the big, beautiful bill passing this weekend, and I think that's important because it obviously moves now towards the Senate. But the key takeaway there is what the think tank is talking about, which is this idea that up until now, until 2034, we're likely to add another 3.3 trillion onto the deficit, or if they're going to extend some of the temporary elements or temporary provisions of the budget, which we'll talk about in a minute, it's going to be around 5.2 trillion. Okay, now this I think fundamentally matters. This I think is market moving. This I think is where all the attention of the market goes to, not just over the course of this week, but into next week, where we know
absorption
that Besant is wanting to really push through this bill as quick as possible ahead of that May 26th deadline. Okay, it's only 1 week away, but I expect bonds are going to be extremely sensitive over the next couple of days and into next week, and that's ultimately where I think we're going to get a fundamental shift. Okay, if you're going to see some fundamentals, if you're going to see a new narrative shift, it's going to be around this idea that, hey, US government, you told us you were going to rein in the spending. Doge didn't save any money. You're telling us you're going to ultimately raise loads and billions and billions and billions and gazillions from all these tariffs, but we're not seeing that, and you're spending well beyond your means. Okay. This ultimately, I think, is now the showdown we're going to see between the so-called bond vigilantes and ultimately the US government. Okay, we know fine well the first time we saw these yields spike, we do know fine well that the US government backed off extremely quickly. So again, we'll use that same playbook where if we did suddenly get yields spiking, we got that US 10-year back at 5%, we will of course start preparing ourselves for the backtrack from the US government. Okay, but I think that's now the next big play for this year, which is an explosion in yields to the upside, and ultimately the implications of that for some of the key markets. Now, let's have a quick look at that, because this comment here, or this part of the article, I think is quite interesting, where they're talking about this extension of temporary provisions. Ultimately, what they're talking about, and this is a little bit of a policy gimmick, it's something all the presidents do, and ultimately I didn't know about this until I read about it this morning, but what they're talking about is this idea that what they sometimes do in terms of the budget to get it through is they have these sort of short-dated type provisions where they allow for certain extensions of whatever it might be, certain tax cuts to certain groups, but they do it for a short period of time, for 1 or 2 years, but ultimately it gets extended anyways. So it's kind of a way to say, well, hey, we'll keep it there short term, but in essence they actually mean that it's going to be there for long term. Okay, it's something that a populist president would do. It's this sort of idea of not getting rid of money towards Medicaid, making sure you all those key programs that got you into power, ultimately you extend those for another 2 years beyond, of course, the midterm elections. Okay, so this is the idea here, is that yes, or it's not going to necessarily be there just for a short period of time. It's most likely going to be for a longer period of time, hence why we're talking about this 5.2 trillion. Okay, now the key to all of this is ultimately it's not about the numbers 3.3 or 5.2, it's all about the market implications. Okay, the market's going to guide the thinking around this. We know that bonds were sensitive to higher spending this year, and we can see that on the chart. Okay, this is the US 10-year. You can see that very much over the course of the last 2 years. Yields have not gone anywhere. Okay, and I want to stress that yields have really not gone anywhere. If I was to draw sort of a longer term 200-day average or something, it looks a little bit like that. Okay, in other words, we're not that far above the 200-day moving average, and if anything, we're not going anywhere, but we're not going down. And I think that's the key takeaway. We are not seeing longer dated yields moving down. They do now seem to be starting to drift back higher. And of course, we can see that 5% sort of highest yield we've traded in many, many years is starting to come back into view. Okay. I think this is where the new fundamental narrative could develop. It's very much a case of, if this bill, this big beautiful bill that is supposedly going to be long-term, create lots of growth and reduce the deficit over the long run, ultimately the market's going to determine whether or not that's true, and so you just got to watch the price action, particularly in the long bonds. Okay, they are opening up, they are moving quite a bit already this morning. Does that mean now suddenly it's the end of the world? No, of course not. If the bill is going to be problematic and bond vigilantes are going to start moving, I can promise you're not going to just see 5% yields. You're probably going to see 5.5%, 6% yields. Okay, you'll see something quite dramatic big, and you'll see quite a lot of volatility. We're not there yet. Okay, so don't suddenly open up the chart and go short equities just because I'm telling you yields are moving to 5%. Okay, this is something that will pick up speed, and it's something that I suspect we're probably going to see over the next 10 days. Okay, I think we will probably start to understand the implications of this bill as we move into next week. Okay. Now, one thing I do want to point out is very much the steepening that's going on. We're seeing this continued steepening, and this is typically, if you go back and look at recessions, it's steepening that typically tilts an economy into recession. Why? Well, because what happens ultimately is you got a de facto tightening coming from the long end. Okay, so effectively, as the long end pushes higher in terms of yields, don't forget everything in the US is priced against the long yield. Just think of mortgages. Okay, right now the housing market is pretty much frozen to a standstill, and I suspect you are going to see some cuts to housing market growth price for this year at some point over the next couple of weeks. Why? Well, because look what the 30-year is doing. Okay, we're trading now around that 5.02%. That is the highest yield we've traded since, of course, 2023. Does that mean we're going to explode higher? No, but I do suspect we're going to test that 5.1, 5.10 yield over the course of this week. What happens there? I don't know. Okay, I don't know, but what I can tell you, and this is key to this chart, look at this purple line. Okay, that's effectively the 50-day moving average. You can see that we've topped out twice at that 477. Okay, I suspect over the course of this week and next week, we're going to start seeing that 50-day moving average move above that 4.77. And effectively, this starts to point towards a situation where, well, we're actually starting to see, on average, much higher yields. And we're going to start to ultimately see the implications of that tightening move into the markets. Okay, now, there's an old sort of saying of when the 30-year moves, you want to sit up and pay attention, and that's simply because it never moves. Okay, the 30-year is just generally not a market that moves a lot. That's why no one actually ever references and no one talks about it. But we do, of course, have a 20-year auction this week, and I think that's got to be very, very closely watched. Again, we are just looking for that first weak auction, that first failed auction. It's very, very possible the first one that does fail, all bets are off. You are going to see some significant volatility, so keep an eye on that, of course, later on this week. But that in mind, it's very much a case of now getting to that 5.10 mark, and then what happens next. Okay, we really have to start to understand what happens next. If that bill gets pushed through and yields start to get elevated, 5.15, 5.20, all bets are off. We are going to move into a very aggressive risk-off environment. Okay, that being said, this is a wonderful chart, or a wonderful way to look at both the US 30-year and the SPY, because there is a direct correlation between high yield and equity prices. Okay, the reality is, in a high yield environment, equities will always struggle to bid. Okay, now there are some exceptions to that rule, and I think those exceptions, we've seen them in the last 2 years, where when we have re-acceleration of the economy, in other words, when long-dated yields are being driven by the idea of the economy re-accelerating, in those instances, no, equities tend to do well. Okay, so however, when we have higher yields in an environment of lower growth expectations, like we have now, that causes significant strain in the economy. Why? Because it's de facto tightening. Okay, and this is what I'm trying to point out here, is that you can see the SPY has had this significant rally over the course of the last, sort of month. It's moved into very overbought territory at a time when, of course, we can see that 30-year yield has moved from 4.40 up to 5%. Okay, so we're talking about 60 basis points higher in the 30-year, but the SPY keeps moving up. Okay, now this is not being driven on stronger growth expectations. Okay, and that's why I suspect there's about to be a very significant correction in the SPY, and we're going to see that correlation reassign itself. Now, just a couple of examples. If you go back to 2022, of course, that's when the Fed finally decided to get their act together and start clamping down on inflation, and they hiked very, very aggressively. Okay, in that instance, we of course got higher yields from 2% up to 4%, and of course we had a 24% correction in the SPY. Okay, we then saw yields stabilize. What do we see the equities do? Well, they slowly, gradually moved their way back up, having a nice correction. Okay, we then had another spike. If you go back to Q3 2023, that's when we started to see, of course, much hotter inflation, much hotter economy. Yields spiked all the way up to that 5.10, and we had a little mini correction after what was a very extensive rally for most of 2022 and 23. Okay, we then again entered a period of what? A lull. Yields went absolutely nowhere, and that opened up the gates for the SPY then to have a sustained rally starting in October 2023. Okay, the reality is at the start of this year we started to see those yields push again. We of course got a little bit of a correction, and then we did have a stabilization, but now we are starting to see those yields push back up again. Okay, we get above that 510. What I'm pointing towards is once we get above that 510, we are now going to enter a new higher yield. We're going to see that 50-day average yield move higher above that 477, and that's going to act as a significant strain on the SPY. So keep a close eye on that. I suspect that correlation is about to reattach itself, starting of course with today's session. And then finally, just in terms of the term structure, because I think this gives us a little bit of a clue as to how to approach this. I don't suspect we're going to return to the VIX of 60s. I think we're now kind of have mostly, we're mostly beyond that point. But what I want to stress is the VIX is sitting at 20 still. Okay, it's not really gone substantially below the 20 mark over the course of the last couple of weeks. But ultimately, the VIX is still elevated. It is, a VIX of 20. I know it doesn't sound very high, but a VIX of 20 is actually quite problematic for the equities, and especially when we are so overbought. Okay, so what I want to stress with the term structure is just we have seen a little bit of a shift in the term structure as a result of that Moodys data, but it's not panic stations. Okay, the term structure as of today, looking outward, we're still sitting below a 20 VIX. So it's not like the market's going, oh shit. Okay, that's the point. Now what that means is we've got to be a little bit more nimble as traders. We can't just hit lows. Of course, we can see the S&P's down 80 points on the day so far. And what I suspect this means is, yes, we are going to keep drifting lower, but it's not going to be a case of we're just going to drop 200 handles in a straight line. Okay, the key here is it's going to be a sell into rally type approach rather than hit every low and it'll just puke 200-300 points in a straight line. Okay, we're just not in that same environment that we were in, of course, April. Okay, that's in a wrap for today. We haven't got any major economic data out today. Some of the key data points, of course, will come a little bit later in the week where we start to see the PMIs come from the likes of Europe and the US. Those will be very closely watched just to get an idea of the tariff implications. So it's not a significant data week this week. We will, of course, have that 20-year auction, which I think is going to be quite important. We've got a couple of Fed speakers, but right now it's less about what the Fed speakers are saying and a little bit more about what the hard data is doing. So it's going to be all eyes on that market PMI data, which we get on Thursday. Okay, if there are any other questions, do post them in the Discord channel. Otherwise, make sure you like and comment on the channel. It really does help us grow the numbers. Otherwise, good luck out there. Go manage the risk. Go make some money.